Hey guys, Steven Sun at Homes by Sun with Remax here, doing a final walkthrough for my seller client before the closing tomorrow. And I wanted to talk about an important consideration when selling a rental property that's owned by a non-resident of Canada. Now, this one simple mistake, if an agent is not familiar with the tax system, can make the seller not be able to close and therefore get into a huge problem on closing and potentially being sued. So pay attention. Now, this house that I'm in is in this exact situation. It was previously tenanted since my client purchased it, and right after the purchase, they decided to take a job overseas and of course declare that they were a non-resident of Canada so they could pay less tax. Now, for the purchase though, they did get a mortgage of around 75% of the purchase price. Keep in mind that they've always reported this rental income to the CRA, and so CRA is aware that this property is being used as a rental property. Now, during a normal sale, on closing, the seller's lawyer gets the balance of the payment from the buyer's lawyer and pays off the seller's mortgage and other fees, and then the remaining amount is paid to the seller. But in the case of a non-resident selling any property, including previously owner-occupied home, is subject to a withholding tax of at least 25% of the sale price. This amount increases to 50% if the property was previously rented out. So imagine this. Say the seller bought a house worth $1 million, and right now they have an outstanding mortgage amount of $700,000. If the property sells today for $1.2 million and it was owner occupied, then on closing, the lawyers will keep $300,000, the bank will get their $700,000, and the seller gets roughly the rest. So we're okay. But imagine the same situation, but this time the house was rented out as an investment property. So on closing, the lawyers are required to withhold 50% or $600,000. Now we have a shortfall of about $100,000 to pay off the mortgage, plus the seller will owe other costs such as commission and legal fees. So where is the seller going to get this money from? Well, they need to have this extra $100,000 taken from somewhere. It may be from a credit line or another property. This withholding tax requirement is something that many agents miss, and their seller gets a big shock right before closing when their lawyer tells them. Also, imagine that even with the home the seller previously lived in, they could have remortgaged the home to the max before the sale, and now with the prices softening, even withholding 25% could cause them not to have enough money from the sale to pay off the mortgage. So if you are a non-resident seller, you need to speak with your Canadian accountant first, and also make sure you work with an agent who specializes in working with non-resident owners like myself. Otherwise, you could be in for a lot of surprises. There are more details that would affect your tax obligations depending on your specific situation, and we have clauses that could reduce your exposures. I'll save those for another video, or if you'd like to know more, be sure to reach out to me. Now, the good news is you can get some of the withholding amount back once you have filed your tax return or obtained this clearance certificate or comfort letter from CRA. Right now, we're looking at anywhere between 3 to 6 months to get that. If you have any further questions, make sure you give me a call or message me. Again, my name is Steven Sun with Remax, and I look forward to speaking with you. Bye for now.